Wardrobe change.
Wardrobe change.
Do we think that's another mega trend? What people will be wearing in 20 years?
Most likely.
Yeah, I'm not sure we have a view on that, but if history is any guidance, then probably it'll get a little more casual and comfort oriented, I'd imagine.
I wouldn't mind that.
Vanguard used to be, this is before I joined, but Vanguard used to be, for a long time, actually, tie in a suit and a tie place. So talk to people who've been here for 20 years. I think for most of their first 10 years, they had to wear a suit and a tie.
Yeah. Yeah, I remember when I was interning for this company, going into the city, taking the 2-hour commute in a suit, and then the first couple, and in the summer too, in New York City, and then the first couple years, it was I needed to make sure I owned at least 4 suits, because most of the time you were wearing a suit. When you weren't wearing a suit, it was a shirt and tie. How things have changed.
I feel like at weddings these days, I don't wear ties unless it's black tie. And then I'll rock a non-black bow tie. I never do the black tie. I always do like some pop of color. But neckties now are very rare for me.
Yeah.
We ready to kick it off then?
Yeah.
All right, let's cue the music. All right, so welcome back, everybody. Today we have Kevin Kang. As one of Vanguard's senior international economists and head of its global economic research team, Kevin is at the forefront of deciphering the forces that drive markets and economies. His expertise spans econometric forecasting, portfolio construction, risk management, tax-aware investing, and household finance. Kevin joined Vanguard in 2017 as a senior risk manager in the firm's quantitative equity group. He then went on to serve as head of active and alternatives research before stepping into his current position. Before Vanguard, he was a director at BlackRock and a senior quantitative researcher at State Street Global Advisors. Beyond the research desk, Kevin is a prolific author and speaker. His work, covering everything from financial crisis and deleveraging to factor investing and tax efficiency, has been presented to global policymakers, portfolio managers, academics, and financial advisors. His insights are frequently featured in the news and media. Kevin holds a PhD in finance from Northwestern University. He holds an MA in economics from the University of British Columbia and a BAH in economics from Queen's University in Kingston. Welcome to the show, Kevin.
Thank you, Austin.
What's a BAH?
I asked the same question.
A good question. I think it's more of a Canadian thing. I'm not sure if it's a British thing too, but they somehow made a distinction between the 3-year people who decided to stay in school for 3 years versus 4 years. So if you kind of look at it more from an American college standpoint, it's just basically a BA degree, 4-year college degree.
There you go. Maybe a little more specialized than a general BA.
Yeah, I think again, it's been a while, but I think. And most people got that degree anyways. And then I recall you just had to take a few more, maybe several more 3rd and 4th year courses in your chosen discipline.
Got it. We like to start off with the hard-hitting questions here. Thanks for joining us, Kevin. We're looking forward to talking today about Megatrends, the white paper you guys put out. So it should be a great episode.
Speaking of hard-hitting questions, I am fairly certain that our viewers know of an economist, but I don't think many know or understand what an economist does. If you had to explain what you do today to a 10-year-old, how would you describe, being an economist?
So I mean, the word economist there are so many contexts in which economists are hopefully adding value to various organizations that they're part of. So, I think an economist really doesn't, the title economist doesn't really do justice to really describing, okay, what is that you do? just because such a great variety. For my job, for our team's job, probably the best way to explain that to a 10-year-old, and I'm actually going to borrow a page from our colleague who's actually done that, to the 10-year-old son that he has. So he's really just putting together kind of puzzle pieces. So you can kind of think of it as the main job that we're interested in the markets setting is to basically every day trying to get your finger on the pulse of where is the economy. And the thing about the economy is there are all kinds of data that government agencies and private sector data providers compile that will give you a clue on where the economy is. But most of the time, you can't quite know where it is at that given point in time. So just because there's a lag between data collection and there's some adjustments and when that gets released, and the economy itself sometimes is slow moving in the sense that, you don't really mind having that lag between when the data was collected, whether a month or a quarter ago, and when you actually get to see where the economy was at the time versus when you get it. But there are times like probably right now where there's a lot going on in both the economy and the markets, and then people are wondering where's the economy like right now, compared to even 2 or 3 weeks ago. So there is a lot of these indicators that tell people, or at least give inklings to people that, okay, we're probably moving somewhat fast. At least that's a suspicion or hypothesis. And then, so those are, right now would be one of those times where it's actually a lot more exciting. There's also much more volatility in terms of where the forecast might be, or variance, I should say. And that's basically what we do. We put together puzzle pieces, and then sometimes theory comes in from textbooks, sometimes just better data. But it's really a bit of a jack of all trades type of profession, especially in the market setting, just because you need to lean on so many different disciplines.
Austin and I were talking a little bit before you jumped on. The economy is like a steamship, right? It takes a lot of, it can move fast, or if there's jarring accelerations or decelerations, you feel it a lot more. Maybe like what's going on today, time will tell. Yeah. But I think it's also important for viewers and listeners to differentiate and understand the difference between the economy and the market. Mm-hmm. And I heard a great analogy or way to describe this. Imagine you're walking a dog on a leash, right? Yep. And you are the economy. Ultimately, if you want to walk a certain way through the park, that's the way you're going to go, right? The dog's not going to pull you one way or another. Maybe it will deviate you a little bit one way or another. The dog's going to chase a squirrel that way, try to climb a tree or go to the bathroom over there. The dog is like the stock market, where it moves much more drastically and more volatilely, but ultimately it's tied to your leash and tied to you, which is the economy. So I'm looking forward to, and I know we're going to get into it, but talking about some of these mega trends that can affect GDP growth, the economy, and what implications that might have for investors and for the market participants as well.
Yeah, that sounds great. I mean, the only thing I would add, I like that analogy a lot.
It's not mine. I didn't create it, but
well, that's great. Give credit to where give credit where it's due. But the only thing I would add to that analogy is that the dog is a pretty well trained dog, and he kind of knows it kind of knows the routine, so it really anticipates where it might go, and sometimes it's absolutely right, and sometimes it could be pretty wrong.
Sure.
Awesome. Should we dive in?
Yeah, let's dive in. So Vanguard has this piece that they came out. I believe you guys are coming out with a book called Megatrends that you were directly, you directly influenced, right? You were on the team that put this information together. So, what can you tell us about megatrends? What are megatrends?
Yeah, so I think the discussion we just had is a really good segue. we were kind of saying that, right now there's a lot going on in the economy, and then we all want to know, and then I feel like we'll want to know where the economy is. And then maybe if you dial back to about a year, I remember a similar level of intensity and question around, okay, when is the Fed going to start, cutting rates? So if you kind of think about how much time we actually spend, both the economists and the market, and attention that we spend on trying to figure out where is the economy now and where is it going to go, that's an enormous amount of energy that we all, as a community, dedicate to. The genesis of Megatrends work that I've been fortunate to be part of, and there's a whole team behind this work here at Vanguard, was that, well, if these sort of a quarter-over-quarter, month-over-month efforts in putting the puzzle pieces together certainly matter. It would be important for example, fixed income fund PM's outperformance, because that is the quantity that they're after, and then there's a huge market around it. But if you actually take a few steps back and look at over the span of, let's say, 10 years or 20 years, how important each one of these decisions was, it turns out that they're actually not that important. Meaning, what explains, going back to what Adam was saying, what does explain the longer term economic growth? At the end of the day, I guess that is the backdrop of not only the economy, but consumers, and then business owners, firms, and then the corporate, even profitability environment. What is driving much of that? And it turns out that it's not the decision by the Fed, every FOMC meeting, but it really is the productivity growth. It really is other things like, okay, is the economy, where is what is the demographic profile like for the economy? What's the level of debt? How much debt are they, adding in order to grow or in order to just sustain? So we kind of started with the notion that, okay, there are these sort of longer term forces, and we just kind of gave them a name, megatrends, but it's really, for the most part, longer term supply side forces that are, in the end, the most important things that drive the economy. So that was a thinking, and then there is that view that's out there, both in the academic literature as well as in certain pockets of private sector community. So what we want you to do is, okay, if that's the view, let's actually take that view to the data and then see how important they are. So I just mentioned productivity, but then productivity can actually be, you can go a level deeper and then see different types of drivers of productivity growth. So we wanted to get as granular as possible with that thinking. And then what we decided to do was, in order for us to do that with data and then add some, numbers to it, because there's a difference between just being able to say that at a high level and then kind of quantify things. We realized that we needed a lot of data. So that's where our, the main leader of this work, which is our global chief economist, Joe Davis, his background came in extremely useful, which is an economic historian. So he had this data going all the way back to, late 19th century, which is, when the U.S. was really coming out of more of an emerging economy status, into becoming what we have come to know, which is the leading economy in the world. Anyway, so we had that proprietary data that goes all the way back to the late 19th century, and then we decided to, okay, let's bring some heavy duty machinery, econometric technology on the data, and then see which one of the key megatrend forces are really important in driving the economy forward, as well as financial market valuation. So that was a genesis of where this project came from, and then we were able to put together what we think of as more of an X-ray of, okay, what were really propelling and driving economy forward. We were able to, after the work was done, able to really reread the economic history of the last 130 or 40 years through the lens of both the megatrends, which again are more of a slow-moving supply-side forces, as well as the cyclical drivers, including things like business cycle fluctuations and interest rate movements. So
right. So that's pretty fascinating, especially because you use such a long period of time. You think about all the structural changes that have happened both in our economy and the markets, right? Throughout, these mega trends have to have been pretty persevering, right? And I think you guys boiled it down to 5, right? It's technology, demographics, fiscal deficits and debt, globalization, and geopolitical risk. Right. So your analysis going back that 130 years or so basically says these are the 5 elements to what drives the economy. Is that
correct?
Fair? Okay.
Correct. Yeah. Well, so that's correct. And then I think, just to add a bit more color, what we find is that of all of them, of those 5, what's really most important is the technology. And within technology, there are 3 additional. You can go down one level more granular, where it's the kind of total factor productivity broken down to GPT, which is general purpose technology, and then augmentation and automation. So you can kind of see GPT usually leading the other 2, augmentation and automation, whenever there is that sort of productivity surge wave, and then it sort of ends up propagating through automation and augmentation. But yes,
I'm sure we'll get into some examples of that historically and what might be coming down the pike. But
Sure.
I just find it fascinating that we have enough relevant data set going back hundreds of years. I mean, it's kind of funny because what I love about this is it simplifies what everyone watches and hears every day in our lives now. It's like, media and information is so in our face. And it seems like there's, 7 market moving relevant data points a week, one for every day, that are just coming at us. And when it's good, it's good, and no one really cares and ignores it, right? But when it's bad, it's like just this compounding effect. And I think it's fascinating, A, that we have the data going back that far, B, that it's pristine enough to derive relevant trend information from, and then C, just that there's really only 5 things that we can attribute a lot of our growth and these waves of technological improvement. We can dumb it down, and not to dumb it down, but boil it down to 5 things. It's always good to take a step back and reflect that all the noise is just noise, and there's bigger things at play that we should be paying attention to.
And then we're also, it's in the paper, but we're also able to, because we are able to quantify the role each one of these megatrends have played, quantification then leads to being able to add a lot more color on the true importance of some of these trends. So, maybe I'll just pick on demographics. There has been, enough chatter about, okay, well, the U.S. is growing just older. As a function of the demographic profile, and then that could lead to a more of an inflationary world. So that's one camp. There have been people who've said that, and that's one way to look at it. But the desire for the work that we did with all these mega forces in one holistic framework is we actually really wanted to run a horse race between all of them and see really how important has demographic dividend been, even when even when people believe that it was extremely important. So the general sort of general myth or general belief is that, well, we've been reaping the demographic dividends for generations now, or for at least a few decades. And that may be so, but then at least through the lens of our framework, when we actually try to quantify it, it wasn't as important in either keeping the inflation down or for the boosting of the asset prices. So it did play a role in the suspected direction when we looked through the lens, but then it also didn't necessarily play as big a role, which then gives us an idea and then at least an estimate, a reference point to kind of build on, what would the future be like when we do know that the demographic, we're going to be again becoming a little more of an aging society as an economy. But we're able to attribute the right amount of drag from that, which is really not that much, to the economic growth, in part because we've been able to see how important or not that important it was in the past. And same with globalization.
The whole concept of millennials being pitted against boomers is kind of false then.
Well, obviously there are other considerations there as well. So I'm not sure if I want to get into that, but I mean, I will maybe just
you plead the fifth.
I will just maybe continue the thread of globalization as well. Like again, there was this school of thought that because of the 80s and 90s trade liberalization, and then we're able to really benefit from the deflationary forces coming from China and then other trading partners. And then that really contributed to a lower inflation. And we're finding that, but in our framework. But what we think is actually more cooler than that is actually it's really not, it's not that important. That the magnitude of that impact was really not the major one. Like when it comes to inflation, whether it was a surge in inflation in the 1970s or the sort of more of a disinflationary environment in the 90s, it was what really mattered for inflation was actually that the Fed was setting its expectations correctly. That explains most of it. And it's not the demographic forces or the globalization that was driving some of these or most of the inflationary inflation changes over time. So it's really the quantification then that allows us to, we can see that these mega forces were important, but then going forward, we can give it the due, only we can attribute only the right amount of importance to it as we think about the future scenarios.
Right. So if I'm understanding you correctly, just to kind of connect the dots here, the thought process was the globalization that this young working staff would, is keeping inflation low because there's more people out there working. So that is making it so, the wealth is spread around more, I suppose, and then that would then therefore keep inflation down. Now we're moving into a timetable where that population is getting older, and so we may see the inverse effect. But then you're saying when you run your analysis, when you run this model, the Fed kind of sits over top of all that as the grand wizard saying, no, you guys are going to move in the, inflation's going to move in the direction we want because the tools that we have at play are just that powerful.
Yeah, so maybe let's unpack the baby boomers narrative, the importance of demographic profile and inflation a little bit. So the thinking of inflation, when people say, okay, we're becoming an aging society, that means there's a less supply, labor supply, which then could translate into more of an inflationary pressure. So that's a very, very clear, I think, logical economic logic one can follow. And then generally what follows after that is, okay, therefore, there will always be this constant inflationary pressure, which, again, we follow as well. The question here is, how important is that? How important has that been? So that when I say how, that's more of a quantification question. So let's kind of go back to how important that was in the 1970s. And I pick on 1970s because that's actually like late 1960s into mid 1970s is when the baby boomers were kind of like coming into the labor force. So if you think of the sort of demographic pyramid, it was changing from a pyramid into, something that's kind of fatter in between because baby boomers were rising up and, you had a lot of labor supply. So if you're to follow that logic of, okay, high labor supply, that means somewhat deflationary, because you have a lot of labor supply. That means people don't have to pay as much to keep them employed. But it turns out that we had an incredibly inflationary decade in the 1970s called the Great Inflation. And the reason for that, with the benefit of hindsight, we can say that is because central banks around the world had to learn the lessons of keeping inflation expectation anchored, which is the foremost important thing. Well, it's one of the two key mandates. Important thing for the central bank. And at the time, they hadn't quite learned that lesson. So that is a main driver, turns out, of the inflationary environment that we live through. And that, what we're saying is, puts the demographic narrative in its proper place when it comes to its impact or potential impact on inflation, which is far, far, far below the role of monetary policy and the role of central banks' ability and commitment to keep inflation anchored.
Right. Yeah, that's fascinating, especially the example you gave, because the 70s is kind of the poster child for runaway inflation, right? So you have this force that's supposed to keep inflation down at a time when, that's what everyone refers back to when they think of, what's life like in a high inflationary world.
Yep. And that's the world that, just to maybe kind of fast forward or foreshadow a little bit, that's the world where we do not want to go back to. But as we kind of look out into the future, we see kind of two quite contrasting scenarios. One being AI-driven productivity really carrying the day, and then the other being the increasing weight of debt accumulation that's driven by structural deficits that the economy will have to run, kind of putting a lot of weight on the economy. That's the world that, in a way is a close cousin to that latter scenario that I just mentioned as we look out into the next 10 years.
So let's build on that. How does debt deficit draw down the economy? How does that create that headwind for the economy?
To answer that question, let me kind of take a step back. There's a difference between deficits, and then let me direct you to page 15. So let's actually unpack what we mean by deficits a little bit. Not all deficits are necessarily counterproductive. Some deficits are actually necessary. So the way to think of deficits between productive and structural is such that what are productive deficits? These are the ones that are used as counter business cycle measure. So think in terms of recessions. Whenever you're in recessions, you kind of hear there's a talk of, okay, what kind of fiscal stimulus package might we pass? And so we saw that happening during GFC, and we saw that happening maybe in a little too much coming out of COVID. But those are what we would call productive debt, because at the end of the day, you kind of need some agent in the economy to fill that gap in aggregate demand during these lean times when nobody else wants to spend that much, money out there. And then by propping up the economy through debt, funded government spending, it has a way of really tiding the economy over, and then making the recession, if it comes, more of a shallow event. And that's generally something that people would pay for, and that's why we think it's a productive use of debt, because that would be a price worth paying, and the return on that deficit, that would be a productive number.
Right. Sure, you often hear of infrastructure spending, right? Getting people back to work, even if it's more manual labor, but big sweeping projects that can prepare for future growth in the years ahead.
So I mean, that's precisely what a lot of policymakers do. They always say, don't let a good crisis go to waste. Meaning, a good when they're responding, especially through fiscal measures in response to a financial crisis, they usually try to pair up those objectives. One is to just literally have spending out there from the government so that it actually props up the aggregate demand. The other is, can that actually achieve other longer term objectives that we believe would be helpful and constructive for the economy? So those are good examples that that would fall in that bucket. Now, as you can see in the page 15, generally speaking, the amount of deficits the government was running here in the States has been kind of moving in tandem with unemployment rate. So that kind of goes back to where deficits typically go up, which is during leaner times. Well, it turns out that they have really started diverging the last few years. And our view, as well as the CBO's view, is that it's going to continue to be, to a degree, diverging, absent any fiscal consolidations or any sort of an attempt to a little more, bring a little more discipline into the fiscal deficits. And that's what we mean by structural deficits, meaning deficits are structural. It's structurally tied to the economic aging demographic profile of the economy. That just, a bigger portion of the population, namely boomers at this point, are retiring. They're claiming Social Security, which needs to be funded. And then there's a whole host of healthcare-related entitlements that they've been promised all this time. And then to be able to fund that is going to be, a challenging thing. Actually, there's really no way to fund that continually going forward without running a deficit. So if you actually look at the Congressional Budget Office's analysis looking into the next few decades, you can see the projection, most of that is actually going to be driven by the rising outlays on healthcare and Social Security related costs. And
I think you have a slide on that on the prior page.
That's right. Yeah. And then, that's right. And then if you, so it's supposed to go up it's already at a level that is very close to the prior max, which is interesting because the debt to GDP, the last time we hit that level is at the end of World War II, which again, it's war-related spending. Everybody understands it's temporary. Whereas going forward, the force that's going to propel this forward into a new level of debt is going to be structural to pay for things that are very, very different from either war-related or recession-related. And that's the sort of a situation we're looking at, and that's why it's a very formidable mega trend that we'll need to look at. And then kind of going back to your original question, Austin, okay, well, how is then that level of debt not constructive or not helpful to the economy? With that level of debt, you start actually having a couple of things happening. Number one is the market starts really picking up on its inflationary impulses. So we've already seen that in the 80s when deficits were rising for structural reasons, 70s and 80s. But also we are starting to see some of that right now with this rising structural deficits. That's number one, and that's going to then creep into the level of yields, which then will have a way of really propping up the cost of debt financing in general, not just for the government but everybody else. And the second thing is more direct, which is just that level of debt at some point, sooner or later, will register in people's minds. And you kind of have the kind of repeat of 1980s and a little bit of 1990s in the beginning, where people start wondering, okay, we understand that the U.S. government is good for, they're good for their money. But at the same time, the risk is rising. And bond investors at some point might start demanding, I need a premium if I'm going to actually hold this debt. When I see the fundamentals certainly not getting stronger. Right. So that would be another channel through which it'll weigh on the economy. And then if you think about it, there is sort of a crowding out of other types of investment. If the U.S. government is running this level of debt, to just fund healthcare related and the Social Security related expenses, then that is crowding out other types of debt issuances that could be potentially more productive from the private.
So you're from the private sector, right? Okay. So what, and I guess it's been long held that as long as, if I'm going to borrow from a company, as long as that company is growing, at a pace, potentially even faster pace than they need to support the debt that they have, right? Then that is a good investment. It's not a great investment when they owe me X amount of money and they're not even growing at that amount, type of thing. So, to come back to what you're saying is, we need to be careful of, is the economy of the U.S., is that growing? And we measure that by GDP, right, at a rate sufficient enough to support the debt that we're taking on. And that's where you're saying where we could see the economy start to slow under those conditions. Correct.
And that's a good point about the growth rate of the entity that's basically issuing, these debts. And that, in this case, that's a U.S. economy. And that's why when all is said and done, we had mentioned 5 mega forces, which I've explained in the past, but really looking forward when all is said and done, we think that it's really going to be a contest, tug of war between productivity, which is going to be driven by AI, and the weight of debt that we expect to just continue to rise. And as long as the productivity piece is helping the economy grow at a rate that is certainly higher than the last 10, 15 years, maybe at a level that's close to the 1990s, in the second half of the 1990s, for a sustained period, then that would be the situation that you just described, where the economy is growing at a healthy enough pace, let's say a little over 3%, then you're certainly able to pay for the deficits that you continue to have to run, and that actually gives you the fiscal room to actually potentially not have to feel the weight of the rising debt. And then the debt rate, the debt to GDP, or the deficit to GDP, won't need to be as high as the current projection, because the GDP itself is rising as fast. So there's a multitude of virtuous effects that would happen if the economy's growth picks up and then is sustained at a level that we once saw in the second half of 1990s. And the reason I pick on 1990s is because that was the last thing that most of us with a living memory have seen that is closest to a GPT-driven economic transformation, where productivity level is it's on a different level. And it's really that really positive supply side forces are carrying the economy forward. And that's the second half of 1990s is the closest that we've seen. And then our view is that hopefully what we're seeing the first inning or two of AI-driven productivity growth now is going to be something a little more productive than what we saw in the second half of 1990s.
Yeah, right. We've talked a little bit about that in our own webinars and that we've done for clients and outlooks. Mm-hmm. Just that as long as they're not, all of this spending that's going on needs to have some level of productivity that comes from it, or we could have some issues. And the timing, whether we start to see that this year or next year, can have short-term effects. But if we don't get that ultimate GDP productivity growth from all of this investment, that could be bad for the longer term outlook. There's a slide on the GPTs in the past, the general purpose technologies over the past. I see, the 90s was the internet, personal computers, electricity's on here. I imagine flight travel is rail travel, flight are some of the, I'm thinking of the historic ones. AI is currently going on today. Is there anything major that I missed there?
No, the only thing that we are now showing there is the kind of, it's more of a complex story. It doesn't just boil down to electricity of the 1920s. 1920s in a way is a very easy one. for storytelling, just because electricity was so transformative in terms of how it changed the economy and how it really, for once and for all, changed the way people lived. The only other period that we really missed, we're not showing there, is the post-war period, from the late 1940s into basically the late 1960s. That 20-year period was, I think, what a lot of people call the golden age of American business. But also there was a lot of technological innovations and advances that have come out of having just fought two wars, especially World War II, that then have propagated through the manufacturing sector. And, that again, there were a whole host of other factors that made that period such a high productivity period. But, certainly that would be another example.
It's
actually,
also, I was just going to say, it's also funny to think of the 2000, coming out of the great financial crisis, that with the rise of social media and Netflix and everything, there haven't really been any truly transformational technologies that have taken place. It's all applications of the internet, right? So I think it's an important differentiation to make, that AI could be truly transformational in the way we behave and act and work and communicate and whatever it might be. So
so that's a really good point about the last 15 years or so, leading up to maybe a year or two ago, that we feel like we've seen a lot of innovations, and I'd agree with that. But then that's the key question that we would ask going back as well as looking forward, which is, when all is said and done, how much is this new innovation, new technology, helping us produce more and just be more productive at work, both at the micro individual worker level, but also at the sort of a business level. And it turns out that a lot of the innovations that you mentioned, may have been a very great revenue generator for some of the leading tech companies. But when it comes to just everyday worker, there's a question on, exactly how much more productive are you as a result of social media? It's questionable. And the data is actually saying, in no unequivocal terms, that we're actually stuck in low gear in terms of productivity. We were over the last 10, 15 years or so. So that's actually important. And then maybe the only other thing that I'll mention on
just to that point of being stuck. I mean, people do business on spreadsheets for the last 20 years, right? Nothing's changed there.
You just get better incrementally, and that's precisely what the labor productivity and total factor productivity is measuring. Like, are you getting, how much more marginal productivity are you squeezing out every year? How much better are you getting? More productive are you getting every year over year? And you're right, things really haven't changed a whole lot over the last 20 years. And
I think that's a really interesting perspective.
It is. Yeah, because you would think that it did, a lot has changed, right? I'm sure a lot of our listeners are saying, what are they talking about? But when you start to think about the way we operate our businesses and things like that, I'm still using Excel, right? I'm still, it may look cleaner and it may be quicker, but I'm still using that same base technology. There's nothing, absolutely new. It's been a while. And I think the timing is actually kind of crazy that, it's been this 15, 20 year dry spell of this major new technology. Yeah. And right now we have this older population who's only getting older, who are promised government support, and quite frankly, need government support, in certain populations that aren't working. That's going to create this strain on our economy. And out of nowhere, after this 15, 20 year dry spell, steps in AI, right? And AI could potentially save the day. It's almost movie-esque in the timing of this all.
Yeah, I think a lot of people have said never bet against the U.S. Economy and U.S. market, and I think there is something to it in that this is a very entrepreneurial, innovative economy, and in a way, it's been a long time coming. We wouldn't have gotten to where we are now had it not been for all the innovations and investments that have been made. And then that's the thing about GPT. Electricity itself was invented, even before the advent of the 20th century, but it took a while for things to kind of lead to the commercialization of electricity. And then even from that point on, it then took some more time for that to actually propagate through the economy and change the ways in which manufacturing was done. The floor plan was redesigned. So that's the thing with GPT. It actually tends to take quite a bit from the point of invention to the point of an applicability to then actually having an impact on the economy. Think about the 1990s as well. Again, the computer, like personal computer, was around, had already been around. But the second half of productivity surge, a lot of that has to do with just Microsoft Office Suite that was becoming available for the first time. And then it was just, the condition was ripe for that to become mass propagated and diffused through the businesses who were making those investments because it was a no-brainer. So we're kind of like at an interesting point that is maybe parallel to where that is, where with the advent of ChatGPT from about 2.5 years ago, everybody with a cell phone, which is about everybody, can actually have that tool. And I imagine most of your listeners, as well as just really most everybody, has that on their phone. So in a way, we've already had access to a version of a large language model, which is, to a degree, it's a game changer on certain tasks. And now it's, from this point on, it's just the game is about, the name of the game is, okay, how quickly is this type of technology going to diffuse through the economy, and how much evolutions will we need to go through for AI to really start saving some time and relieving us, all of us, of some of the more mundane kind of routine tasks, so we can then actually use that sort of freed up time to pursue things that are a little more higher value add in all of our occupations. And there will be a great amount of variation depending on your occupation, but our expectation is that it's actually going to be reaching and impacting at least 80% of all the occupations that are out there, and then it's going to be saving at least 20% of time for all of us that are out there.
So do you guys at Vanguard, do you guys consider how much time we have before the proverbial train, hits the U.S. economy, right? You just mentioned, a potential, timeline for, when is AI actually going to have its impact, if it does have the impact, right? Do you guys look at the other side of the equation of how much time do we have?
How much time do we have till we get there? Till
we run into issues, right? If I'm a listener saying, wow, we have this older population who's not adding to productivity, but we need to pay them, right? How much time do we have until we need something to come into play to help increase, GDP to support that?
The tug of war, essentially, right? The pull of, deficits and structural changes that need to be made versus the growth that could help us pay for those structural changes.
Yeah, so I think you have to approach this sacred task of forecasting the future with the humility it deserves. I think it's hard.
We'll talk in forms of probability, not certainties, right?
and forms of probability is how that's the language we speak when it comes to these things. I think it's hard. That's why we're giving it about 10 years. And probably within 5 years, we'll get a better color on which direction it is headed between the AI-driven productivity growth and the weight of structural deficits just weighing on the economy. The AI-driven productivity growth is an interesting one. And I do, we think that we're going to be prepared to spot it and see it a little more readily this time around compared to the late 1990s. where, frankly, late 1990s, not a lot of people had kind of gone through that type of transformation when they were actually going through it in like 1996, 1997. It wasn't until 1998, after multiple revisions of productivity numbers at the economy level, that people were actually able to see in the data that, oh my, we're actually growing, productivity is actually a lot higher. But then with the benefit of hindsight, we could tell that that was already happening in 1996. And, Chairman Greenspan at the time, to his credit, actually had a view that they were kind of affected by the tailwind of productivity growth, even as early as 1996. So many in the economy, though it's been almost 30 years, have gone through the 1990s now. So I think that's kind of tailwind for us. That's helping in the sense that we've kind of like lived through that episode once. So we know we're not entirely new to having experienced that. Number two is, I think we kind of know where to look, which is, okay, and we probably are much better as a society to be able to measure that, which is, there are a lot of businesses that are kind of picking up, AI and generative AI tools now, and they're kind of rolling it out. And then we're actually able to measure just how much more productive are we getting. And the sense right now is that there is the take-up is actually very high. The rate of adoption is anywhere between 20 to 40%, and that's more of a general level. But if you go into certain industries and occupations, it's at the close to 100%. So that's a pretty rapid adoption rate compared to relative to when this technology first came out, which was about, again, 2.5 years ago. So I think this year and into next year, we'll learn a lot more about the rate of adoption. And the expectation is that it's going to be pretty fast. So if we're kind of like comparing to all the other adoption curves of different technologies in the past, including cell phones, internet, the leading view is that it's going to be faster and steeper than it was before. So we may get there quicker. That said, it still requires a decent amount of business investment. And, whether it's ChatGPT or any other one of those tools, it's really only the beginning. And then for every individual occupation, you're going to need something a little more customized, to really harness all the benefits that this tool will have to give us. So that's where the view that it'll need to go through a decent amount of maturing and then evolutions in order for us to really fully reap the benefits. But that's why you kind of put them all together. Our view is that in the next 5 years or so, we'll have a much better color.
So I think that's really fascinating. So if I'm a listener, and I don't have a finance background and I'm hearing this, I probably more than likely saying, all right, I got a AI stock, I'm buying it, right? How many are there? I'll take all of them. Maybe I'll take 10 of each, right? Is that the mindset that people should be taking, or in Vanguard's view, is that the with investing, you can always bet on this horse or bet on that horse, and no matter how much strategy says bet on horse B, if horse A wins, horse A wins, right? But just in the way to approach their money, right? Is that right. Vanguard's stance? What's Vanguard's stance on that?
So okay, I'm betting all my money on AI stocks may have been the narrative that has been driving, or that had been driving the market up until maybe close to the end of last year, 2024. And that is very, I want to say it's predictable, but that's it's known to have happened before in the past as well. So whenever you see this game-changing type of technology, and whenever people see that type of potential, and I think we all do from this, from AI, and then what it could do for the economy, then that has a way of really unleashing a little bit of an animal spirit, but also the expectation and then a bit of a pie in the sky type of euphoria. And I wouldn't necessarily use the word euphoria to describe the market condition coming into this year, but certainly an extended expectation, sort of an elevated expectation of what it can do. So that's how I would describe where the market was coming into 2024. In terms of how we're thinking about approaching this, is that's generally how it has played out. Meaning, whenever there is this new GPT, and there are economic agents, usually the firms that are driving it, but then all the economic benefits that would come out of the economy actually harnessing the technology doesn't always accrue to the provider of that technology. So, well, maybe I'll just pick an example from the .com bubble. Cisco, what was a good company that was certainly laying down the infrastructure for the new economy that was being built. The problem with that, with the thinking that, okay, I'm just going to go in all on Cisco at the time, was that it was just not the right price, nor did all the benefits that came out afterwards accrue to Cisco. It had a way of really accruing to a lot of other economies, and the elevated productivity really affected much of U.S. corporate sector in general, rather than just Cisco. So similar thinking could be applied as we look forward for AI as well. And then I'm actually, I'm just going to throw in another example, which is in the 1920s, there were, I want to say, hundreds of automobile companies that came into existence. And again, this is a pattern that we see in history, economic history and financial history. Whenever there is something new, there's a huge interest, and that really invites a lot of entrants into the field. But turns out that the benefits that you would eventually reap as a society do not all accrue to those specific companies. And even then, the industry itself might be a little too big, a little too saturated and crowded. And then eventually there will be winners and losers, even among the ones that are so visibly leading that sort of a transformation for the economy. So coming back to your question, looking forward, we actually think that in the current valuation, the right way to approach this with a longer term perspective is to actually tilt towards more value stocks. And the thinking is very straightforward, which is if the AI wins scenario comes to pass, then it's going to really lift all boats. It's the productivity that's going to make not only the IT sector, but other sectors as well. And that would more likely than not translate into their sort of enhanced abilities to generate earnings. And that right now is not really priced at. Number one, it's too far out. So you would need to be able to really imagine that scenario. But for two, that's just not how the market generally thinks about these things, because it's, again, a few steps out. So that's how we would approach this. And then similar thinking could be applied to developed markets outside of the U.S. as well, which has a lot of value flavor. It shares a lot of that sort of value flavor with U.S. value stocks in the current market condition. So that's how we would think of it. And then in thinking about it, maybe just one more thing. In thinking about about it that way, you can never, if you're more of a balanced investor, then that's more of an upside that we're talking about here. You also want to think about the downside, which is AI, for one reason or another, doesn't end up translating into the boost in economic productivity.
Right.
And that leads us to then more of a higher inflation expectation, higher yield return environment, with more likely than not valuation contracting, multiple contracting. And that would be an environment where, having gone all into AI stocks right now, wouldn't turn out so well.
And in the context of a 60-40 portfolio, that's the 60%, right? How are you building out and recommending, not you, but Vanguard recommending through the lens of this megatrend model? How are you looking at the fixed income side of portfolios? Because a lot of our clients hold bonds. I've fielded some calls recently regarding U.S. Treasuries and wanting to limit exposure there. What does the fixed income side of the portfolio look like according to the megatrend model?
So according to the megatrends model, and again, where I just want to maybe emphasize that this is a secular long-term view, not speaking to the current environment. We actually think that in either scenario, fixed income is not in a bad place. So let me maybe qualify why that is. Because we are, when we're thinking about not only the upside scenario where AI actually, carries the day, but also the downside scenario where, you have the weight of the rising government debt weighing on the economy. The very fact that we have gone through 1970s, and then we've also just gone through a much smaller episode with the 2022 inflation episode. Our view is that the Federal Reserve is not going to let inflation rise, ever to the level that we experienced in the decade of the 1970s. And that means, yes, inflation expectation is a little higher. Maybe that translates into a slightly higher inflation, but that is very measured. So your downside risk of yield going through the roof because of an unhinged inflation expectation is very minimal. And against that backdrop, in the downside, you're still going to have a decent amount of yield curve rising, generally speaking, because people are pricing in increased risk premium, and then potentially a little more term premium as well. And that's actually not a bad environment. And then we're kind of like placing maybe 5%, 4 to 5%, maybe higher end of 5% in that scenario. That's kind of our view of where the yield is going to be. And that's actually not a bad environment, starting where we are now, because over time, if you look at the total return from a bond portfolio, generally speaking, your initial yield certainly matters. But also, as long as you're reinvesting at a higher rate, as long as that rate, the delta is not too dramatic, then you may not be gaining too much from a price, yield decrease and price appreciation. But in the end, the reinvested interest actually translate into a really nice return. So from either environment, what we're seeing is the yield curve is not coming down too much longer term, and that translates into a real durable return in real terms, and that gives us the confidence that fixed income is actually, in either environment, is a good place to be. And maybe I'll just add that, speaking of active fixed income, we think that if it were to go down the path of maybe not AI-driven productivity growth, but the deficits drag scenario, then that actually certainly will invite more volatility in both equity and fixed income markets. And that would be a kind of a new environment for many fixed income players to navigate, just because we're so used to, generally speaking, yield curve coming down, having lived through the environment the last 20 years or so. So that is another place where we think that that would be another insight to think about fixed income portfolio allocation.
Yeah, that's great. That's great insight. So, based on your Vanguard's analysis, yields should remain attractive. It could pay to remain more nimble. I like what you said on the equity side about respecting valuations, right? Just because an AI name is an AI name doesn't mean it's not priced to a point where you're not going to see much more growth out of that based on its future growth pattern, right? I would qualify for our listeners that Kevin used the word tilt and not dive into value, right? to keep that broad allocation, you do have to respect what these companies are doing for the economy as well as respecting valuations. I like what you said about how if AI fails, you probably don't want to be all in AI names, right? Now when I read the research, it said, I had the highest probability is that AI works, right? And we conquer this, deficit issue, this older population, growing. If AI fails and the deficit drag scenario plays out, what does that look like for the market? Is that a market's falling apart scenario, or is that just the market's just not going to grow as much as it may have if AI did come, or some other technology for that matter came and increased productivity to a point?
If the deficit drag scenario plays out, that's disappointing on a number of fronts and concerning for the same reasons. Number one, that means the economy isn't growing as much, and that would mean a little more like the repeat of the last 10 years or so, again, leading up to COVID, because I want to make a distinction between before COVID and after COVID. But, that 10 years of kind of anemic growth, that would be more of a macroeconomic backdrop. The difference would be that we're kind of starting from a place of having a lot of enthusiasm and expectation built into, especially U.S. growth heavy stock universe in valuation already. And sooner or later, if we're not seeing growth, then that means probably an enormous amount of pressure on the valuation. So that would be the key force that's driving on the equity front. And that would then probably come with a decent amount of volatility. And in that environment, it's actually, again, more attractively valued risk assets that would be able to withstand that type of volatility and probably have a less of a hit to their valuation compared to the ones that are priced for near perfection right now. So that's on the equity market, and even on the risk market, just risk asset side, that's how we would think about what might happen.
Right. So maybe more volatility, growth, but less growth than we would have had. That's interesting. That makes a lot I
was just going to say too, it's funny because we're talking about 5 to 10 year mega trends, but what we're saying is so timely for what's happening in the market the last 6 weeks. And we talked about this in our, annual winter webinar. Just if you break out the valuations of tech and other AI and, the Mag 7 names versus the rest of the market, there's a drastic difference, and the rest of the market is not overvalued egregiously, right? And in this sell-off, we've seen valuations come down in those names that had a lot of high optimism, euphoria centered around them. And I think I just keep coming back to the day when the DeepSeek news broke, where Nvidia was down 15%. 300 out of the 500 names in the S&P 500 were positive that day. Yet the market as a whole, the S&P 500 at least, was down over 1.5%. And our client portfolios are, I would say, more aligned with the way you're looking at this mega trend portfolio tilting towards value. It's important it's important not to be absent of major technological change within your portfolio, but within reason, and respecting those valuations is very important.
So I have maybe 3 quick points to add there. Number one is, just to be clear, if AI actually, if the AI win scenario plays out, our upside scenario plays out over the course of next decade, then our view is that it's actually going to translate into growth companies really not losing much in terms of valuation, but delivering still probably a lower end of double-digit return annualized through earnings growth. So that view is still there. It's just that we think that, so that's number one. And then the other thing is, all all of this, what I've just shared about the 10-year outlook and investment outlook, is, as you say, is informed by the current valuation assessment, right? Like, that plays at least half of the role. If things were differently valued and priced right now, our view may be different, but that's playing a pretty key role in how we're thinking about the 10-year outlook. And then I think the last point, which what you said, Adam, is interesting, is that I know we're going through this elevated volatility, mostly for different reasons, but I do think that it's an interesting and probably useful stress test, like a miniature version of stress test.
Valuation releases like this can come in many different. There can be many different excuses for why people wanted to sell some stock and valuation.
And it doesn't need to go through the eventual sort of disappointment of economic growth just not being there. That actually sounds a little smoother. Whereas when things were priced as near perfection, I wouldn't use the word of uber euphoria as we would have used it for 1990s situation, but certainly the downside risk wasn't priced in much. So that even that possibility. So now that we're facing that is certainly reminding a lot of us that you just can't, most of us anyways, can't really anticipate where the downside risk will assert, but valuation tends to be a useful signal.
Sure. Well, this is
I have one final question, and then we can wrap it, Kevin. But I would guess that when a lot of this research was put together and talk about structural deficits being a headwind, right, that we need to overcome, I would guess that there was no. You had no idea that Elon Musk and DOGE would have such a drastic impact. In like 60 seconds, can you indicate whether you think that's going to have a material impact on helping the structural deficit headwind?
Yeah, no, that's an interesting question. That's an interesting view. I think one way to look at it is I think it's actually healthy for one reason or another that we're all talking about this, because if you were a student of the deficit discussion from like the 1990s all the way until late last year, you would have noticed a very gradual but stark change where in the 1990s there were bond vigilantes, and then CEA director and others were saying, "Oh, I wish I could be a 25-year-old bond portfolio manager because of the amount of discipline that they were infusing into the budgetary process." And we went from there in the 1990s to somehow just having gotten entirely numbed to the amount of deficit that we were running. And again, a lot of it is structural. And our sense is that certainly everybody's talking about it now, again, for one reason or another. And then that's...
that can't be a bad thing.
That's not a bad thing that we are talking about it. Now, how we get there, I'm sure that's a
we can debate that all day.
Much more involved discussion and process. But the very fact that we're talking about it, I actually think it's a healthy.
Yeah. Well, we'll have to have you back on in 10 years, hopefully with good news. If not before then, Kevin. No, I'm kidding. This has been fantastic, very thought-provoking. I know we're just scratching the surface, so we'll link the white paper if that's published and able to be put out there in the wild. We'll link that in the show notes. So definitely, if you enjoyed this conversation, to all of our listeners and viewers, give that a read. It's great, and we really appreciate you coming on.
Kevin, when does the book come out?
The book's coming out in late May. I want to say the last week.
Late May.
Last week.
Okay. Oh, so soon.
Awesome.
Okay, great. Well, we'll keep an eye out for that. Appreciate having you on. Thank you, listeners, for listening. Please shoot us a like, hit us a follow, and we'll talk to you next time. Thank you, Kevin.
Thank you.
Thank you, Kevin. That was awesome.